Welcome to the deep dive. Today, we're going to cut right through the usual market chatter.
Yeah, get straight to it.
Exactly.
Yeah.
We're looking at an approach that, well, it promises to be genuinely different, kind of no BS in its philosophy.
I like the sound of that already.
We're talking about a strategy that, fundamentally flips the script, moving away from chasing those, let's face it, often elusive quick wins.
The ones everyone seems to be after.
Right. And moving towards something more methodical, almost, dare I say, predictable, a way to collect consistent income.
Okay, intriguing. What's the source for this?
Our guide for this deep dive is refreshingly direct,
Yeah.
very actionable. It's called Sell the Fear, Puts for Income and Account Growth by Cordero.
Sell the fear. That's quite a title.
It is. And look, this isn't about wild speculation or gambling. It's framed as a direct route to trading like an owner, not a gambler.
An owner, not a gambler. I like that distinction.
And it's specifically designed, it says, for anyone, even if you're just starting out with a smaller account.
Ah, that's interesting. Because what's really fascinating right from the get-go is the stark contrast this source draws.
Yeah.
It pretty bluntly calls out the hype chasers versus the smart traders. It's almost audacious.
Hype chasers versus smart traders. Okay.
So this deep dive, we're really going to explore why selling puts gets framed this way.
Yeah.
Like, how is it harvesting premium directly from market fear?
Right, the fear aspect.
And crucially, how that mechanism can actually translate into tangible, consistent growth for you, our listener.
So our mission today.
Yeah, our mission is basically to dissect this strategy.
Sure.
Selling puts, understand the mechanics, not just the theory, but practically.
How it actually works day to day.
Exactly. And reveal how it's presented as this consistent path, both for income and for growing your account, even if you're starting small.
Okay.
But it demands a shift in mindset, a really foundational one, moving from just reacting to the market
Which is what most people do.
to actively setting the terms. And that's absolutely crucial for long-term success, it seems.
Sell the fear. That title, like you said, it really tells you so much about the core idea here.
It really does.
The book basically argues, look, most traders are stuck chasing hype. They buy options, usually expensive ones, hoping for that one big score.
The home run.
Yeah, the home run. And the reality, they lose more often than not. It's just how it goes.
Unfortunately, yeah, that's common.
But the smart traders, according to this source, they do the exact opposite.
They sell the fear.
They sell the fear, they sell puts, and the immediate benefit, the undeniable one.
You get paid up front.
Bingo. You
Yep.
get paid up front.
Totally. You go from being a speculator, always on edge, hoping for some big price jump,
Fingers crossed.
to becoming someone who actually collects money, a premium, for
Yeah.
taking on a defined, manageable obligation.
Defined and manageable, that's key.
It's about consistently collecting, not perpetually chasing. A totally different game.
Okay, so if we zoom out a bit, connect this to the bigger picture, how does this shift you away from, well, what often feels like gambling?
Right. It fundamentally moves you from that pure speculation zone.
Which, let's be honest, feels like gambling a lot of the time.
It often is. It moves you towards a much more grounded mindset, almost like a business owner.
Okay, a business owner of your trading account.
Sort of. Think about it. When you sell a put, you're not just hoping a stock goes to the moon overnight.
Right.
Instead, you're strategically using the fear or uncertainty that's already in the market.
Leveraging it.
Exactly, leveraging it to generate income. And this happens in one of two ways, both designed to be good for you.
Okay, what are the two ways?
Well, first, you might just keep the premium you got paid up front. If the stock behaves, that's pure profit.
Nice and simple.
Or, second, you might end up acquiring assets, stocks you actually want to own, but you get them at a better price, a predetermined price you were happy with.
Ah, okay. So even the other outcome is potentially good.
That's the whole point. It sets the tone for a strategy that's described as consistent. And, crucially, without that typical high-stakes gambling feel you get with a lot of option stuff.
Right.
The book is super clear. Only two outcomes for the seller, and both are framed as desirable.
Oh, broke those down again. Outcome one.
Outcome one. The stock price simply stays above the price you agreed on the strike price until the option expires.
Right.
Then the option just expires worthless. Poof. And you keep that entire upfront cash, the premium, pure income, no further action needed.
Okay, that's the ideal scenario for just income.
For pure income, yeah. But then there's outcome two. And this is where the mindset shift is huge.
This is if the stock does drop below your strike price.
Exactly. If it drops below the strike price, you are obligated. You made a promise. Remember to buy the stock.
Which sounds like losing to most people.
Right. But here's the genius. According to the source, you buy it at that predetermined strike price. A price you already agreed was good value before you even entered the trade.
So it's a discount compared to where it was when you started, maybe even where it is now.
Precisely. You acquire it at a discount you were happy with from the start. This transforms what seems like a negative getting assigned shares into a planned, maybe even desired acquisition.
Wow. Okay. That reframing is, it's pretty powerful, turning potential panic into just executing the plan.
Exactly.
The source calls itself a blunt, simple guide. Why do you think it hammers that no BS angle so hard, especially for growing a smaller account? It really feels like it's trying to shake people up.
Oh, absolutely. That direct, almost raw language, it's totally key. Its main job seems to be stripping away all the confusing jargon,
There's so much jargon.
all the unrealistic hype, and maybe most importantly, the emotional traps that trip up so many traders, especially new ones.
Right, the fear and greed cycle.
Totally. It tries to counteract that widespread myth, that you need tons of cash or secret inside info or some super complex algorithm to actually make money.
Which is intimidating, especially if you're starting small.
Exactly. For a smaller account, say you're starting with $5,000, maybe $10,000, every single dollar of profit and every loss you avoid counts big time.
Yeah, you don't have much room for error.
None. So the no BS approach makes sure the core principles land without any fluff. It pushes for disciplined, practical application right from day one.
Get it right from the start.
Yeah. It's basically saying, look, this isn't magic. It's not get rich quick. It's presented as a methodical income-generating machine if you follow the rules rigorously.
The rules are key.
Absolutely. It stresses this is how you grow steadily. Avoid gambling. Focus on lots of predictable, high-probability, small wins, not chasing those wild swings that usually end badly. It's an authentic, unfiltered take on what actually works according to Cordero.
Okay, I get it. So let's peel back the layers then. Deconstruct the actual put option. We hear the term, but what is it? From both sides, buyer and, crucially for us, the seller.
Right. The source lays it out simply. A put option gives the buyer the right, not the obligation, the right to sell a stock at a specific price.
That's the strike price.
The strike price, correct? By a specific date, the expiration date. For the buyer, it's often like insurance, protection against a price drop.
Okay, that's the buyer. Now, what about the seller, the smart trader in this story?
Right. When you sell a put, you're taking the exact opposite side of that deal.
Okay.
You're essentially saying to the buyer, okay, you want the right to sell me your 100 shares of XYZ if they drop to, say, $50 by next month. Fine, I'll promise to buy them from you at $50 if they hit that price or go lower. But
There's always a but.
you got to pay me right now for making that promise. It's a direct, clear, transactional agreement.
So you're literally getting paid for your willingness to potentially buy later.
Exactly.
Yeah.
You are compensated up front for taking on that potential obligation. That payment is your premium, your immediate reward for providing that insurance or guarantee to the buyer.
It feels very contractual,
Yeah.
very businesslike.
It is. It removes ambiguity. You know exactly what you're getting paid and what you might have to do.
So for the seller, it really is like getting paid to set your own terms for a potential purchase.
That's a great way to put it.
How does this actually play out then? The premiums, the protection aspect, the potential ownership, it sounds like it forces a certain discipline.
Yeah, this raises a really crucial point. How does this structure inherently encourage discipline? And how does it protect you?
Right.
Well, the very act of selling a put forces you, like up front, to think hard about the price where you'd be genuinely okay owning that stock.
Not just hoping it goes up forever.
Exactly. It's about accepting responsibility for the trade from the start, not just reacting later. So let's break down the mechanics.
Okay.
First, the upfront premium. Cash in your account immediately when you sell the put. Simple as that.
Instant gratification, kinda.
Yeah, a little bit. Now, if the trade goes as planned, meaning the stock price stays above your strike price until expiration.
The option expires worthless.
Right. The option expires worthless. In that ideal income scenario, you keep the entire premium. It's basically income earned from time passing and the market being uncertain without your obligation ever kicking in.
Like collecting rent, the source said.
Yeah, collecting rent without the leaky faucets.
Okay, but what about the other scenario? Stock falls below the strike. Assignment.
Right, assignment. And this is where that mindset shift is non-negotiable. The book hammers this. Assignment is not failure. It's part of the plan.
Okay, say it happens, what then?
When assigned, you are obligated to buy 100 shares of that stock for every put contract you sold. But here's the protective part. You buy them at the strike price.
Which you already decided was a good price.
Exactly. A price you already agreed was acceptable, maybe even desirable. You're buying at a discount to where the stock might be trading now, or certainly where it was.
So the protection is locking in that purchase price.
Yes. You're protected from having to chase it higher, and you're protected because you chose that price. It turns what many fear assignment into a deliberate strategic buy. You basically got paid to wait for your entry point on a stock you already liked.
That makes a ton of sense. It's about setting those terms up front. Okay, so we get the mindset, we get the mechanics of a put from the seller's side. Let's get into the nitty-gritty, the actual step-by-step blueprint the book lays out.
All right, let's do it.
It starts, and this is emphasized as absolutely non-negotiable, with stock selection. Rule number 1, stated very bluntly, pick a stock you'd actually want to own. No junk. Why is this the foundation? Does it ever feel too limiting?
It's not just paramount, it is the foundation, the cornerstone, because sticking to this rule completely removes the fear of assignment. Think about it.
Right.
If you only sell puts on companies you've researched, you understand, you believe in long term, then getting assigned isn't a bad outcome.
It's just buying the stock you wanted.
Exactly. It's an opportunity to acquire a quality asset at a price you already decided was a bargain. Imagine the opposite. You sold a put on some random meme stock you know nothing about.
Oh boy.
Right, you get assigned, now you're stuck holding shares you don't want, maybe at a price that just keeps tanking. Disaster.
Avoidable disaster.
Totally avoidable. By focusing only on quality, you turn that perceived negative into a planned, maybe even welcome acquisition. It elevates the strategy from just speculation to something closer to disciplined value investing.
So you're not just looking for a stock that won't fall.
No. You're looking for one you'd be genuinely happy to catch if it does fall to your price. It manages risk and your own emotions. The book's really raw here. If you don't want to own it, don't sell puts on it, period.
Got it. Crystal clear.
Oh.
So you've picked your solid company. Next step. Navigating the options chain. The source suggests looking 20 to 60 days out, monthly expirations mainly, and choosing a strike below the current price. That's your cushion.
Right.
What's the thinking behind that 20-60-day window? And how far below the current price should you typically aim for that strike? Is there a sweet spot?
Okay, the 20-60-day time frame is considered a sweet spot mainly because of time decay, or theta.
Theta decay. Works for the seller.
Massively in the seller's favor. As an option gets closer to expiring, its time value just melts away faster and faster. So each day, part of that premium you collected becomes yours, even if the stock price doesn't budge.
Okay.
Options too close, like under 20 days, they decay fast, yeah, but the premiums are often tiny, hardly worth the effort or risk.
And too far out, like 90 days plus.
Too much time means more chance for big, wild swings that could hurt you before time decay helps. Plus, your capital is tied up for ages. Monthly expirations usually have more action, more buyers than sellers.
Better liquidity.
Exactly, better liquidity, which means tighter bid-ask spreads. Less friction cost for you.
Okay, and the strike price. Below the current price, out of the money. How far below?
Choosing a strike below the current price out of the money, that's your main safety net, your cushion.
Right.
The further out of the money you go, lower strike price relative to the stock price, the lower the probability of the stock actually hitting your strike before expiration. So, safer trade.
Lower premium, right?
Yeah. But lower premium, that's the fundamental trade-off, risk versus reward. The book consistently guides you towards prioritizing safety and consistency over grabbing the biggest premium.
Makes sense for the overall philosophy.
Yeah. So if a stock's at $105, maybe you sell the $100 put, $5 cushion. If you sold the $90 put, that's a $15 cushion safer, but you'll get paid less up front. The goal is high probability wins, those base hits, not home run attempts.
Base hits, not home runs. Got it. And then the rule that seems to come up again and again, position sizing. Sell one contract per 100 shares you can afford. Stressing cash-secured puts, absolutely not margin. This feels like the heart of the no gambling rule.
Whoa, it absolutely is. Maybe the most critical rule for steady growth and, frankly, for survival.
Survival sounds dramatic, but probably true.
It can be. Cash secured means exactly that. You must have the full amount of cash needed to buy those 100 shares per contract you sell, sitting right there, liquid, in your account.
Earmarked for that trade.
Earmarked, set aside. If you get assigned, boom, that cash is used to buy the shares. No ifs, ands, or buts.
And the danger of not doing that. Using margin.
Catastrophic. Using margin means borrowing from your broker to cover that potential purchase. Leverage.
Leverage cuts both ways.
And it cuts deeper on the downside. If the stock drops hard and you're on margin, you could get a margin call. Broker demands more cash now, or they liquidate your stuff, usually at the worst possible moment.
Nightmare scenario.
Total nightmare. The book's absolute insistence on cash secured eliminates that risk entirely. If you get assigned, you're just buying the asset you wanted, with cash you already had. No debt, no forced selling.
Playing defense first.
Completely. Build wealth safely. Stay in the game. Only risk what you actually have. It's conservative, responsible. Not for quick buck artists using borrowed money. It's disciplined building.
Okay, solid foundation. So position set, cash secured. Now, the guide talks about active management. Collecting the premium, but also managing the trade. It says very directly. Exit early if you get 50% of the premium fast. Don't get greedy. And if the stock dips, but you still like it, you can roll out the put. This sounds like an active dance with the market, not set and forget.
Definitely not set and forget. And that emphasis on proactive management and discipline, that's a huge contrast to the hope and pray method.
Oh, yeah.
It's not just setting it up, it's knowing when to get out, when to adjust. That's the smart money approach right there.
So what's the most critical part of this management phase? Is it that 50% rule?
For me, yes, that instruction. Exit early if you get 50% of the premium fast is huge. It's incredibly critical.
Why not wait for 80%, 90%, all of it?
Because it's not about squeezing every last drop. Taking profits quickly does several vital things for you. First, bam, you reduce your risk. Less time in the market means less time for something weird to happen.
Makes sense.
Second, you free up your capital way faster. That money can go straight into the next high probability trade. Faster compounding.
Keep the engine running.
Yeah, exactly. And third, psychologically, it builds confidence. You're consistently banking wins. Small wins, maybe, but wins. This directly fights that urge to get greedy.
Holding on too long?
Holding on too long, watching profits vanish, or worse, turn into losses. Protect gains, rotate capital efficiently.
Okay, 50% rule is key. What about rolling out? Sounds useful if things get dicey.
Rolling out offers crucial flexibility. It's your adjustment tool. Say the stock dips, gets a bit too close to your strike for comfort, but fundamentally you still like the company, you're still bullish long term.
Okay.
You can roll out. Basically, you close the current put you sold, might be a small loss on that specific option trade, but not necessarily overall, and then you immediately open a new put. Same stock, but with a later expiration date.
Buys you more time.
Buys you time. And often you can choose a slightly lower strike price too, giving you more cushion again. And here's the kicker. You typically collect more premium when you do this.
Oh, interesting. So you get paid again to adjust.
You get paid to adjust and wait. It's like a business owner managing inventory or adjusting plans based on current conditions, not just rigidly sticking to plan A no matter what. Tactical flexibility within that disciplined framework, always aiming to preserve capital and keep collecting income.
That's really smart. It's about consistent gains, not those unpredictable big swings. And speaking of consistency, the book digs into growing a small account, like $5K to $20K range.
Yeah, very practical.
It keeps hammering. Start small, cash secured, no margin. It really feels like a marathon, not a sprint. Consistency over heroics.
Absolutely. That focus on starting small, cash secured. It's not just safety, it's like a strategic must for smaller accounts. When capital's tight, every dollar counts, right?
Every single one.
Avoiding margin means one bad trade or weird market move doesn't wipe you out. You stay in the game, you learn. For these smaller accounts, the book highlights key strategies people often miss when they're chasing fast money.
Like what?
First, you have to focus on liquid stocks.
Yeah.
Stocks with tight bid-ask spreads and lots of volume.
Why is liquidity so critical here?
Friction costs. For small accounts making lots of trades, those costs can kill you. If an options bid is $1 and the ask is $1.50, that's a 50-cent spread. You instantly lose that much just getting in and out.
Eats into your small premium.
Hugely. If you're only collecting $1.50 or $2 per contract, losing 50 cents right away is massive. Tight spreads, maybe just pennies wide, mean your money works for you, not the market makers. Subtle, but vital for those base hits.
Okay, liquid stocks. What else?
Second, it's all about stacking wins. Base hits. The whole philosophy is keep raking in small, consistent premiums.
Build it up slowly.
Incrementally. Many small, high-probability successes compounding over time requires patience.
Yeah.
Huge mindset shift from market gambling.
Right, and it specifically says avoid something.
Ah, yes. Third, and this is directly avoiding hype. Avoid earnings plays explicitly.
Why? Isn't volatility higher, meaning bigger premiums?
Exactly, because volatility is insane and the direction is totally unpredictable around earnings. They're pure gambles.
Coin flips.
Basically coin flips. You might get a fat premium, sure, but the stock could gap down 20% overnight, blowing way past your strike. Huge loss. Or your assigned stock way underwater. That kind of unpredictability, totally wrong for a consistent income strategy.
That distinction's important. Some might see high IV around earnings and think opportunity. How does avoiding them fit the selling fear idea if fear drives premiums? Seems counterintuitive, maybe.
Excellent question. It gets to a key nuance. Selling fear in this context isn't about jumping on any fear, especially not the chaotic, unpredictable fear around a binary event like earnings.
Okay.
It's about selling the more predictable fear, the general market uncertainty, the fear premium that exists on stable companies during minor dips where time decay is your reliable edge.
Not the lottery ticket fear of earnings night.
Precisely. Yes, IV spikes before earnings, premiums look amazing, but the risk-reward is terrible for this strategy. You might sell a put for $5 that normally gets $1, but you're gambling on the outcome. This strategy is about high-probability income, not high-stakes betting. Stick to where the odds are actually in your favor. Earnings, not it.
Got it. Pragmatic, control what you can control.
Exactly. And finally, the engine for real growth. Compounding. Reinvesting those small, steady premiums into new put sales. That's how the snowball grows.
Slow and steady.
Grow it slow and steady, the book says. This is how freedom starts one smart move at a time. Patience, method, consistency. That's the path to independence here, not chasing rainbows.
It sounds like an incredibly disciplined system.
Yeah.
Like commandments for trading. Which leads us to the rules of the game section.
Yes, the rules.
And it's full of that blunt talk, never sell a put on a stop you wouldn't own, period. Don't get greedy. Stuff rarely ends well. Very authentic to the no BS style. Why are these rules presented as so critical? How do they help you overcome, the psychological stuff?
Yeah, this really asks, how does sticking to these rigid rules help you, the listener, fight off those biases? Fear, greed, impulse. They derail most traders.
They really do.
The directness cuts through the emotion. It reinforces logic, discipline. Never sell a put on a stock you wouldn't own, period. Golden rule. We've hit it before, but it's worth repeating.
Why is it the golden rule?
Because it flips the script on assignment. If you get the shares, you're not stuck with trash. You bought something you valued at your price. It removes the fear when markets dip because assignment becomes okay, even good, strategic, no panic.
Okay, rule 1 is clear. What about the more technical rules? Delta, IV rank. They sound a bit more advanced.
They are, slightly, but they're presented as essential for optimizing your edge within this framework.
Okay, Delta first. It says aim for 2045 Delta puts. What does that mean practically?
Delta tells you roughly how much the options price will change for a $1 move in the stock. But more importantly for sellers, it's a proxy for the probability of the option expiring in the money.
Meaning probability of assignment.
Essentially, yeah. So a 20 Delta put has roughly a 20% chance of ending up in the money, stock blow strike, meaning an 80% chance it expires worthless and you keep the full premium.
High probability of winning.
Exactly. That 20-45 Delta range, it's considered the sweet spot. Balances a high probability of success with getting a decent worthwhile premium. Go lower Delta, premiums are tiny. Go higher, risk of assignment climbs fast.
Okay, find this sweet spot. What else?
Always use limit orders. Ensures you get better fills.
Yeah.
Don't just slap a market order in.
Why not? Market orders are fast.
Fast, but potentially costly. A market order takes whatever price is available right now. A limit order lets you specify the minimum price you'll accept to sell that put.
So you get your price or no deal.
Right. It might take a few seconds longer, maybe minutes, but getting $1.25 instead of $1.20 for your option just by being patient. Over hundreds of trades, those pennies add up massively. Maximize your intake.
Makes sense. And profit taking.
The same rule again. Take profits at 50% bluntly. Don't get greedy. This isn't leaving money on the table. It's locking in gains consistently.
Reduce risk, free up capital faster.
Exactly. Stack the wins, accelerate the compounding. Core discipline.
Okay. And the last metric. Watch 5E rank. Implied volatility rank. How does this tie into selling fear?
This is where you really capitalize on fear in a measurable way. 5 rank tells you where the current implied volatility is compared to its own history, usually the last year.
So is IV high or low for this specific stock right now?
Precisely. A high V rank, say, above 50 means volatility is elevated compared to its normal range, and high IV means
Fatter premium.
fatter premiums for you, the seller. High 5V rank signals times when the market is likely overpaying for options due to fear or uncertainty. That's your prime time to sell, collecting an outsized payment for taking on that risk, like selling umbrellas when the forecast calls for a storm. Smart timing.
So it's not just what you trade, but when. Very cool. And the source introduces the wheel strategy. If assigned, start selling covered calls. This sounds like the next logical step, almost completing a cycle.
Yes, the wheel is exactly that. It's the natural progression, the full life cycle of this income strategy. It completely reframes assignment. It's not the end, not failure.
It's just a transition.
It's a seamless pivot to the next income phase. Remember the golden rule. You got assigned shares you wanted anyway at your price. Now what?
Now you own the stock.
Right. So you immediately pivot and start selling covered calls.
Okay, what's the covered call from the seller's view?
You own 100 shares, that's the covered part. You sell a call option, which is a promise to sell those shares at a specific strike price higher than your cost basis by a certain date.
And you get paid for that promise too.
You collect another premium up front, so now you're generating rent from the shares you own, continuously collecting income.
Like being a landlord for your stocks.
Perfect analogy. You keep collecting rent premiums until either the option expires worthless, you keep the shares and sell another call, or the stock price goes above your call strike and your shares get called away, sold at a profit.
And the book also says what not to do here.
Oh, yeah, just as important. Rule: don't double down. If a stock moves against you, you get assigned, or you own shares that have dropped. Don't just sell more puts lower down or buy more shares hoping it snaps back.
Don't chase losses.
Exactly. It rarely ends well, the source says bluntly. Stick to the plan. Manage the position you have according to the wheel strategy. Don't throw good money after bad based on emotion or hope. Discipline, discipline, discipline.
That raw honesty is actually really helpful.
Okay.
Very practical. Let's revisit stock selection then with more detail. The guide gives a criteria checklist, almost like a shopping list for this strategy.
Yeah, it's super helpful.
What makes these criteria and the examples it gives such good fix for this income focus? It seems designed to filter out the noise.
Totally. And what's fascinating is how every single item on this checklist directly supports that owner, not gambler philosophy. You're screening for stability, value, predictability.
Okay, first on the list.
Liquid options. Tight bid-ask spreads, lots of volume. We hit this, but it's fundamental. Need efficient entry and exit. Can't lose half your premium just getting in and out, especially on smaller trades. Efficient capital use.
Makes sense.
Second, strong fundamentals. Companies with real revenue, cash flow, solid business model. This is the bedrock for the golden rule.
Wouldn't known it otherwise.
Exactly. You have to be comfortable holding these long-term if assigned. You're buying a piece of a real business, not just playing a ticker symbol.
Okay. Third criterion.
No earnings within 30 days. Reinforces avoiding earnings plays. Minimize that unpredictable event risk. Keep it steady.
Avoid the landmines. Got it. Fourth.
2 related points. No massive recent run-ups and not trading at all-time highs. Basically, avoid stocks that look super stretched, potentially due for a pullback.
Why? Wouldn't a high flyer offer good premiums?
Maybe, but the risk of a sharp reversal is higher. By picking stocks that aren't crazy extended, you inherently get a better cushion for your put strike. You're looking for relative stability, points where fear might be temporarily high, but the underlying trend isn't parabolic. It's about finding calm waters to fish in, mostly.
Stability, predictability, value. Very clear. Can you give us some of those concrete examples the source mentions? Make it tangible for listeners.
Yeah, absolutely. The source gives great examples to ground this.
Like Roy.
Blue chips. Think big, stable household names, proven track records, like Apple, AAPL, Microsoft, MSFT, maybe Coca-Cola, KO. Less volatile usually, diversified businesses, if assigned. You own a piece of a giant. Feels pretty good.
Hard to argue with those.
Dividend payers. Companies that consistently pay dividends, like PepsiCo, PEP, or Johnson & Johnson, J&J. Often mature, stable. If you get assigned, great. Now you own shares that pay you another stream of income via dividends while you potentially sell covered calls. Boosts that owner income.
Double dipping on income, kind of.
Kinda. And third, for maybe newer folks, or those wanting diversification.
ETFs.
Index ETFs. Excellent starting point. SPDR, S&P 500, ETF, SPY. Invesco QQQ Trust, QQQ for NASDAQ 100, iShares Russell 2000, IWM for small caps. You get broad market exposure, reduces single company risk dramatically. You're betting on the whole market or sector, generally safer.
So options for different risk tolerances there.
Exactly. This list helps you move from theory to practical choices. Build a solid foundation with battle-tested, liquid, strong vehicles. Ensures if assignment happens, you're holding something worthwhile.
That really clarifies the what to trade part.
Yeah.
Now let's tackle the moment that probably scares new traders most, but the source flips completely. Assignment. When things go according to plan, navigating assignment.
Yes.
The book says flat out, assignment isn't failure, it's part of the plan. That mindset shift is huge, isn't it? Challenges everything.
It's absolutely fundamental to the whole strategy's resilience and long-term success. If we connect this to the bigger picture, assignment isn't an end, it's just a pivot.
A pivot to the next income phase.
Exactly. Continuous income from the same capital. That's how you get consistent compounding growth. Most new traders fear assignment. They think it means they were wrong or lost money.
Because they didn't just sell high.
Right. But if you followed the golden rule, only sold puts on stocks you wanted, at prices you liked, then assignment just means success. You acquired 100 shares of a quality company at a discount. It should feel like a win.
Like the car analogy you used.
Yeah. You got paid to wait for your price on something you wanted to buy anyway. Now you own it. Strategic, not a setback.
Okay, powerful reframe. So assignment happens, you own the shares. What's the immediate action plan? Not just sit on them, right?
No, definitely not passive. The action plan is immediate, proactive, keeps the income train rolling. It embodies the full wheel strategy.
That's step one.
Step 1. Acknowledge the win. You now own 100 shares of a stock you like at a discount. Use that Microsoft example. Sold the $400 put, got $5 premium. Assigned at $400 when MSFT is $398. Your effective cost is $395. $400 strike, $5 premium. You own MSFT at $395. Good deal.
Okay, check. Step 2.
Step 2. The immediate wheel pivot. Immediately sell a covered call above your cost basis. Find a strike price above your $395 cost. Maybe the $405, $410 strike, 45 days out.
And collect another premium for that?
Collect another premium. Say you get $400 for selling the $405 call against your new shares. Now you wait again.
What happens with the call?
Few scenarios. 1, MSFT stays below $405. The call expires worthless. You keep that $400 call premium, and you still own your under MSFT shares. What do you do next month?
Sell another covered call?
Bingo! Keep collecting rent. Scenario 2, MSFT goes above $405. Your shares get called away. Sold at $405.
So you made money on the stock going up too?
Yes. Profit on the shares, $405, $395 cost is 10 share, or $1,000. Plus you keep the original put premium, $500. Plus you keep the covered call premium, $400. Total profit in that cycle, $1,900. You monetize downside protection and upside potential.
Wow. And then
And the final simple instruction, rinse and repeat.
back to the beginning.
Back to cash, often with a nice profit. Now you can sell another, put on a stock you like, maybe MSFT again, maybe something else, and start the whole wheel turning again. Continuous, methodical income generation and growth. It's elegant, really.
That really does tie it all together, the full life cycle.
Yeah.
It feels like property management for stocks, always collecting rent, one way or another. The promise here feels bigger than just making money. It's like a different kind of financial independence.
Yeah.
Built on consistency, active management.
And that raises that key question for you, the listener. How might shifting your perspective from chasing volatile moves to consistently collecting premiums?
Yeah.
How might that fundamentally change your relationship with your finances?
Yeah.
The source really hammers this smart money mindset in the conclusion. Says selling puts is what banks, institutions, and pros do. It's not some secret handshake club.
It's just how they operate.
It's how they efficiently harvest premium from fear, manage portfolios. It's about collecting, not guessing. Playing like an owner, building a process, not relying on gambles.
Stop guessing. Start collecting.
That's the motto. And the book ends with a super direct, actionable plan. No fluff. For anyone ready to try this.
Okay, what are the steps?
1, open a brokerage account that allows options. Most big ones do.
2,
2, fund it with at least $5,000. Need enough capital to secure one contract of a decent stock you'd own. Gives you room.
3,
3, pick 3 to 5 stocks or ETFs you'd love to own. Do the research based on that checklist. Choose wisely. No fads.
4,
4, start with just one. Put contract. Just one. Learn the ropes, get the feel, build confidence without big risk.
5,
5, track your wins, Watch the premiums add up. See the compounding, crucial for motivation and sticking with it.
And 6.
6. Reinvest the profits. That's the compounding magic. Let small wins snowball into real growth over time.
So it's not just a strategy, it's really a philosophy, a whole different way to approach your money and the market.
Exactly.
This is how freedom starts. One smart move at a time.
Yeah.
It really does feel like it puts the power back in your hands. Encourages that disciplined long-term view, instead of just reacting to the market's whims.
Well, you're setting the terms.
You're setting the terms, collecting income, building your foundation. Wow, this deep dive really has unpacked a unique and a no BS path. Definitely something for you to think about for your own financial journey.